Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
And today we're going to talk about housing. We got a lot of cool information today. Yes, I said cool about things that are normally nerdy. Don't give me the side eye at the top of the show.
Data.
Wah, wah. First thing, guys, housing market update. Supply ticked up in February for the first time in 8 months from Redfin. We got why housing inventory is growing with higher mortgage rates from Housing Wire. And then from Realtor.com, we got housing sentiment is at the highest level in nearly 2 years, Fannie Mae says, because of home sellers.
Whoa.
And from CNBC, we got weekly mortgage demand surging 11% as more homes hit the spring market. And we're not even in spring. Technically.
Not yet.
So
it's still raining here.
A lot of really cool stuff to cover today, guys. And I'm going to tell you, like right out the gate, I'm optimistic about this. So right from the top, we're going to go with Redfin first, guys. Housing market update. Supply ticked up in February for the first time in 8 months. There are more homes for sale as spring approaches, and house hunters are hitting the pavement. Home touring activity is rising, and mortgage purchase applications are up 11% this week alone. So this is a good sign.
Yeah.
Right?
Spring is here.
Spring's here. Spring is here early. Look, I know we're seeing this. I was just talking to one of the guys here at the office, and he was saying that last week at an open house, they had 15 people come, 15 groups through, like in the first hour and a half or 2 hours of the open house.
Yeah.
So even locally, like we're seeing evidence of this. This is happening.
I mean, truly happening. But how many people actually did put an offer in the property?
Well, yeah, only a handful are going to do an offer.
Right?
But
it's great to see all the people. Hello, how you doing?
But one of the things we're talking about is on the Redfin side, of course, because they're real estate database heavy. You know, they're talking about numbers of groups touring, and like their survey of people touring homes is up a lot. But again, that's also part and parcel of the fact that there's more listings. So, but what they're recording here is new listings rose 13% from a year earlier nationwide during the 4 weeks that ended March 3rd, which is the largest increase in 3 years.
I feel a lot of people are starting to realize that the interest rates is a short-term problem, and that the housing inventory is going to be what's actually, the big long-term problem. And if rates come down, which they will, that's going to prompt people to flood the markets, keeping them, prices up and inventory very, very tight.
Yeah.
So until they tackle that problem, I mean, I think consumers finally said, like, shoot, if I wait, I'm going to be waiting and prices are going to stay the same and I'm not going to get what I want.
Yeah.
Competition is only going to be worse. It's already bad now. So let me get my cuts in now and try to get in because, hey, if I can't get in now, good luck when rates get it.
That's it. Though. Exactly.
Yeah, it definitely seems to me that, like, the waiting strategy is not going to work out for people. I mean, waiting did not result in home prices coming down. Waiting did not result in mortgage rates staying low. Now you've got an uphill battle on both those fronts. So waiting did not turn out to be favorable for most people.
Well, it's hard to calculate, especially with this volatile market, right?
Yeah.
It's just hard to calculate. And then when we're talking about 13% increase, when you really think about how many homes that actually is and you put in perspective to your city, that may not be a lot. That could just be, 100 homes or whatever it may be. Sure. So, these are the things to consider as well.
Yeah.
Another thing that that I thought was interesting that the article mentioned is buyers who can afford today's mortgage rates may have better luck finding a home now than they have in the past several months.
Yeah.
So I think, like I said, lower rates are gonna, prompt inventory to go low. I mean, to be even more lower. So now that you have an opportunity, I know it's gonna be tough. Might be a little sacrifice once you get in there, but the future's bright, and if you're able to get in right now, believe me, down the line,
exactly.
More options.
Elections are coming, right?
So. Yeah, that's still coming too. We haven't even hit hit our full stride for spring yet and summer.
Yeah.
And then we got that happening. Plus you have election stuff ramping up. But I mean, look, we're at this point of the year already, and they're saying from Redfin, they're saying touring activity is up 23% from the start of the year. Yeah. Now that's not like, okay. Now, again, I know, great point. Reference, hey, wherever you live, 13% might not be a much. Wherever you live, 23% might not be a lot either. But if you take that number just statistically, that is statistically significant.
Of course.
That's a lot.
Yeah.
And, and this isn't just to try to whip up the market and hype up people to go list their homes. Because, again, that's still decided at the personal level. Yeah. So Redfin could be, let's say, erring on the side of optimism with the 23% increase print. But that doesn't necessarily mean that's going to force me as a seller to go list my house. I still have to decide that's the right thing for me.
Yeah, of course.
So there's that. And then here's the other deal. You have median price, sales price up. Median asking price is up. You have touring activity, like I said, up. Google searches for the word home for sale, up. We have Redfin home buyer demand, up. And mortgage applications, up. So
houses for rent near me.
So I guess the conclusion here is everything is falling apart except it's not. New listings up, active listings up, Months of supply.
Hold on, let me take a guess, please, on the next one.
Yeah. Oh, hold it. Ready? Share of homes sold above list price.
Up. It's
And
actually flat.
average sale to price list ratio. Up. Yes. So, yeah, like, look, I understand this is all relative and it depends on where you're measuring from and things like that. Yes, that is true. We had very low sales in 2023. We had very low inventory in 2023. So, yeah, of course, if there's any sort of recovery and it's healthy in the right direction, it's going to look up. But here's the deal. I will say this about months of supply. Let's take their side of the coin real quick.
This is
Months of supply, 3.7 months, which is not necessarily good, but it's better because it was like at 3 months.
Yeah.
So now we're moving in the right direction, but normal is considered 6, guys. So for those of you new to the channel, new to our show, a normal inventory supply of homes is 6 months, and we're still only at 3.7. We got a long way to go on
what
that
I
front.
find interesting, and this might play to the catalyst of people coming out of the woodworks to get curiosity to buy it, that I always find it that now looking back last year, 4 years ago when you were going through the same presidential candidate voting and everything, I feel everybody starts to feel like, hey, they're going to do something to ease the housing market, so that I feel people are like, hey, let me get in to see what they do throughout the year, because I just read something, and don't quote me because it's probably going to be coming out these next couple of days and weeks, but Biden's working on a tax
10,000.
credit plan. Yeah, tax
first
credit,
time home buyer tax credit.
Which, again, I'm like, yo, why didn't you bring this out last year? Why didn't you bring this out a year before when it actually would have helped? And now it's at the end of his presidency, and I'm just kind of like, well, if you knew you could do this, why didn't you do this earlier?
Because some of it's probably tactical. I mean, let's be honest.
Of course,
even
100%.
if it wasn't him, it was some other president. It's tactical. It is.
Yeah.
100%. But I just feel that that help. Yeah, it's going to help, but only for how long?
Well, I mean, look, it's not going to help the market correct itself, but it might help people qualify into certain things. That might be a benefit. It's going to be a benefit. It may not be a door opening for you.
Yeah.
And one of the things I think working against people is, back to the data, is that of these 50 most populous U.S. metros measured for this report, only one area had a median sale price decline.
Yeah.
Only one out of the 50 had a decline in metro median sales price. And that is a death blow to everyone saying that there's going to be a housing crash of prices and things like that. There was a volume crash.
2008.
There was not a price crash.
Yeah.
And low rates made sure that happened. And now demand is making sure it doesn't retreat from there.
Yeah.
So, I'm sorry to say, but not sorry to say, everyone who was crying wolf about there being price decline and plummeting off a cliff, ain't happening. It's just not happening.
Not anytime soon.
Price declines was in January.
Yeah.
Price declines when it was $10 off.
Yeah.
Fire sale. So, anyways,
everything must go. All inventory.
As far as this one is concerned, guys, you're definitely seeing supply tick up. It's great that it's happening right now, and it's great that it's happening right in this kind of spring season, if you will. I think this is going to spell great promise for the rest of the year when it comes to total home sales.
I agree.
Yep.
I agree.
I remember I know we talked about inventory a couple shows ago. We're making our best guesses and our estimates about how many homes we hit the market. We're going to get to that number a little bit later, but this is getting us in the right start. So
I know I'm still right, so it's all
you're,
good.
You're going to be right, and you are going to be right in the end. I already know I'm going to take the L on that, guys. I way overshot the estimate of homes for sale. So. Did you have a final comment on this, Brian, before we move on?
That was it.
No? Okay, I see you drawing notes over there. Those look looking pretty prime on those graphs there, bro.
Nothing but Doc over here, just pretending like I'm doing something for the cameras.
One thing they also didn't mention is on this, everything was up.
Yeah.
But what was also up was we actually had a lot more price cuts. So people are actually going in there, and their sellers are having to kind of cut down on their price too, in order for them to actually sell the house. So that's one thing that wasn't actually put in there, but.
I think one of the things I noticed about that is it's in, let's say, some less desirable areas. In the hot markets, you're talking about going to Florida, going to Texas, even San Diego. It's like, no, that's not what we're talking about. We're talking about places where it's you have to get that price cut in order to go, okay, it's worth my time to look at.
Exactly. Nationwide thing.
So, all right, let's go to the next one, guys. This is from Housing Wire. We have, why is housing inventory growing with higher mortgage rates? Well, part of this is just hand in hand with the theory that as rates go up, inventory does as well.
Correct.
But let's talk about this a little bit, because we are showing year-over-year growth in inventory despite higher rates. And inventory, now, I want to say this at the beginning, is the quoted number here. Inventory bottom of 2022 was 240,000 homes, okay? Inventory peak of 2023, 569,000. That represents a 329,000 difference from peak to trough.
I mean,
that is massive.
When I saw that number, Andy, that was crazy. I actually had to go into the Fred graph and check that out. Like, how was it? How many homes were actually available? Like even back in 2017, 18, like, because not until we started talking about this is I'm paying more attention to it.
Yeah.
We're very fortunate to be conducting a lot of business at that time, but there was more volume of homes, more active homes on the market. And when I saw this number in January, 240,000 homes available nationwide, that was like a jaw drop right there.
That is very, very thin. Very thin.
Yes.
Very thin.
And they put it right here in context. Like if you put it in 2015, they had 958 homes available nationwide.
Yeah.
958,000.
Yeah. That's a lot.
That's quite a bit.
So,
that's a lot.
Almost 1 million.
Yeah.
Well, I mean, you're talking about that taking a massive plummet. I mean, look, the 2022 number is only a quarter of the 2015 number.
Yeah.
But the difference between 22 to 23 is staggering. Going from 240,000 all the way up to 569,000, that's one hell of a recovery for inventory.
I think for all the crash talkers out there, I think that might have been the crash.
Yeah.
Yeah, that was the
not the crash, but the dip.
Well, but again, it's volume of inventory. It's not. It wasn't a price crash. Like the price correction is really more accurately defined what it was. You saw a 10% correction some places, 12, 15%. You didn't see a 45% retreat on price. And you just saw a lot less homes available.
And I think that's what people get confused about, that they're waiting for it to drop 50, 60, like just completely tank. Where these drops are actually still significant in the long term.
But we've talked about that before. Like I remember I looked at you and I was like, at what point would you step into the market and say, oh, okay, well, if it's 100% price, right, and it's 10% off, it's 20, it's 30. Where do you step in and go, I buy it at 30% off or 20% off? Like I could hold my breath for 40% off all day long, but if he's sitting there on cash and he's like, well, I'm in at 30%, my option's gone waiting for 40.
It doesn't exist anymore.
That's what I'm saying. So, there's a threshold where even investors are going to be like, oh, it's 10% off. Cool. I'll take it at 15% off.
Yeah, they have to. I mean, at what point they're like, hey, I got to work with the numbers that I'm getting right now, and I got to keep moving forward.
Yeah, this is crazy, guys. No, that number 240, I mean, for me, I didn't feel that pain in 2022. There was that many, because we were so inundated with the refi boom still.
It was still basically
carried over.
I still didn't understand, but now if you look at the numbers, the refi was so much higher than the purchase. It's like, oh, I get it. Now I understand it. Looking back at the numbers, and I actually took going back and reminiscing, right? What was happening in 22? There it is.
Like, hey, where's all these sellers at? Oh, damn, I refinanced them all in 2020, 2021.
But here's the thing. That peak of that peak of 569,000 in 2023, that's carrying over. Yeah. We're already seeing that then move into 2024 because when you look at the week over week stats that they put in this article too, you're looking at the week over or the week versus same week last year comparison, and in 2023 this same week. So this same week in 2023 there were 48,000 homes on the market.
Yeah.
Now this year there's 52,000. Like, oh well, it's only 4,000 difference. That's 10%.
Yeah.
That's 10% more.
So
that means if I go ahead and just translate that into the same, let's say, peak number. So if the peak was 569,000 and I plus 10% on that, now we're over inventory over 610,000 right away. So if that week over week comparison or week versus week year over year comparison of 10% plus, it's going to be the same for total inventory peak. We're going to see that cross 600,000 for the first time in years now. Yeah.
Exactly.
So that spells great news for the spring and for summer. And, this conversation is on the tail end of our last one for the Redfin article we started the show with, which is talking about supply of homes increasing.
Still not a market crash, though. So just so we understand it. Still not a market crash. Okay?
It's still going to fall off the cliff. So, in case you have not heard this from us before, the Housing Wire the inventory model that they use here is as mortgage rates head higher, it leads to weakness in demand, which means it takes longer to sell a home and inventory can grow. Yeah. That's only part of it. Inventory not only grows by places sitting on the market longer, which we're not experiencing, it's also just volume of homes going to list.
Yeah. Again, at the same time. So I have a realtor I was talking to, and they're getting all anxious because this property ain't selling. Mm-hmm. And so I look into the property. Do you have any buyers around? I go, well, send me the address. So they send me the address. And then, we have MLS access. So we look into it. It's only been on the market for a little over 40 days.
Oh, that's not that bad.
No, not at all. But
they
were stressing. They were like, well, it's been 40 days. We really haven't had any activity like that.
Yeah, but if
We
it's
have
like
people coming in, but there's no offers. And I'm like, but it's only been 40 days. Like,
yeah, I mean, I guess for here we're a little spoiled, right? Like in San Diego, you're like, oh, list days on market is in the high teens, right? And then it goes to pending, and then it's closed. Yeah,
It's been on the market for 2 weeks.
Yeah.
I'm about to lose it. I'm going to get fired.
But 40 I think is locally abnormal. That's not necessarily completely outside the range of normal when you look at like.
But if we consider the time, rates just this last week have actually kind of started coming out in our favor. You know, we were getting scared when the 10-year yield was going a little over 5. That 4.5%. You know, and luckily it didn't. If not, we would start seeing the rates again back in the 8s. You know?
100%.
So luckily it kind of dropped, but it's like. You know, what people don't understand, in the 9 weeks that we've been in this year, 5 of those weeks were in a decline of applications.
Yes, right.
You know, and so
Good
therefore
point.
it's like we got to really kind of gauge where we're at. And of course, I'm not saying realtors should know this data, but it's hard for them to understand that too.
Well, that's what you have us for. Like that.
Exactly.
That's what all your realtors. You have us for that.
Exactly. And that's why I was just kind of like, don't worry about that. You know, a lot happened. Rates were very volatile. Just give it another week or so. You'll start seeing more activity.
Yeah. I think this is good news, guys. And to carry over from our first article, but I think this is good. There's likely still to be some price cuts. I don't think it's going to be outside the bounds of normal, as people might be expecting, despite the amount of volume coming. If the 10-year yield does hang between the 4 and the 4.3, I think we're going to be really good on rates to see them no higher than maybe 7 and 7 1/4. That's really high, I know, relatively speaking, but there is room to the downside.
So I had I posted an update on rates the other day on my social media, and I had one of my followers reply back to me with the laughing emoji, and I was like, what are you laughing about? And he's like, the fact that you posted that it went from 7.02 to 6.97 and it's been the lowest trending of rates in the last 3 weeks. He's like, bro, rates are still super high. So he really trolled me on there, but I was like, you know what, bro, at the end of the day, we know rates are going to come down, you know? And I use that same example of saying, hey, rates right now are, you know, just a short-term problem. We're going to get through that. We already know the Fed's already been, you know, procasting it. And the biggest thing is it's housing. So if we don't have any more inventory, prices will stay the same. Rates could drop, but I mean, we're still going to be in the same boat.
No, that's
no
but
inventory.
at the same time, so we just locked the loan today.
Yeah.
And it was FHA, and it was locked in at 5.75.
Yeah,
You know
there
what
you
I
go.
mean? So last week and a half, I couldn't do that. I was at 6.375. So the rates have decreased that much, you know?
Yeah. No, that's good. I'm glad you said that. I mean, again, it's all context.
Yeah.
I was gonna say perception. It's not perception. It's context. It's the loan profile. It's what kind of loan it is. It's the person's It's their credit score. It's the loan to value. It's the program type. It's all sorts of things. But 5.75, that's a good deal.
I mean, Andy, that was over $300 some, close to $400 monthly in savings.
That's true.
Yeah.
Come on, like,
Yeah.
who doesn't want that?
Yeah. No. That's
Right?
that's amazing.
And again,
So,
that's just all about timing the market, figuring out, understanding the market conditions, because that's going to persuade the 10-year yield. What people don't understand is that 10-year is going to make the world of the difference. As we move forward when purchasing homes.
I know it's not popular, it's not fun, and people
It's
don't
not.
understand it, but if just start looking into the 10-year yield, and it determines a lot of your financial life if you aren't aware of that. Guys, let's press through, because we're on a good high so far, and that's going to dovetail us into the next thing, which is housing sentiment. So coming in from Realtor.com, guys, we had housing sentiment is at the highest level in nearly 2 years, Fannie Mae says, because of home sellers. Home sellers are feeling a lot more optimistic about the housing market, according to a new Fannie Mae survey ahead of the spring home buying season. In February, the home purchase sentiment index by the government-sponsored enterprise rose for the third month in a row to 72.8, and that's the highest it's been since March of 2022.
Yeah, I believe that.
So it says consumers' attitudes towards home selling conditions increased markedly in February. So I feel like we said sellers finally hit that point where they're like, yo, I either need to really sell or, yo, I need to get out of this because my situation doesn't, fit anymore. I was out voting last week, and I was speaking to one of the people that was voting, and we got to talking. He asked me, hey, what do you do? I told him, I'm in mortgages. He's like, hey, I just refinanced. I'm like, oh, wait, what?
Great.
I was going to say great. I was like, great. But then I paused. I was like, you refinanced? I was like, what? Like, it doesn't make sense. He's like, we had a lot of debt. He's like, we had a lot of debt. So I was like, interesting that you brought that. He's like, yeah, like I didn't want to, but we had over like $200,000 in debt. We had to basically wipe all that out, and we refinanced. My rate went up to 5%. But his biggest thing was like, I didn't want to be drowning in debt. And that was one of the biggest things that I took away from that. He was a regular working man. He works. He was actually working on the Gaylord construction down here on the bay. So he had just got off of work, and he's like, yo, like, I'm not making the money that you're seeing out in the economy, you know? So he's like, my bills are tight. My dollar's not stretching as far as it used to. I had to make this decision because I was drowning in debt. Dude, go back to 2016. His house had just burnt down.
Oh, shoot.
Goodness.
Okay, no, this is a great scenario because that's not common for people. But people think, oh, that's stupid. Why would anybody do that? For that reason.
His house completely burned down. He said it burnt down to the freaking ashes here in Chula Vista area. And he said thankfully he had insurance.
Yeah, of course.
Thankfully, yeah. Had insurance.
Everything got available.
Everything got, constructed back up, and it went good. Apparently he got a little bit more, but I won't say that. But the biggest thing was that he leveraged his property to get out of a huge issue that he was in, over $200,000 in debt, and now he was able to consolidate it all under his mortgage, 5% rate, and I think his payment was still like under like $3,500.
Yeah,
because they had the house like fairly paid down. So, I mean, that right there just goes to show that, there's going to be situations, there's going to be like life-changing situations that you have no control over. But if you have a house, you have a hard backstop, you have a really good savings account that you can tap into and replenish it. It's just, how you really put it down into perspective and how it plays out. Like you brought up a really good example with your client, how you're helping them basically shift around all their stuff. But it makes sense for them, even though they're going from a 2% rate to a higher rate.
Exactly.
The way that you're structuring their finances and their monthly payments, it makes so much sense because they're actually saving money, even with the higher rate. And that's what people don't understand and don't want to listen to because, it's going to be more. No. Break the numbers down, do the math, see it for what it is, and you're going to realize, like, the math does math.
Just reinvest into yourself too, right?
Reinvest into yourself, 100%.
It's not always about the rate. I mean, that's the primary example. It's not always about the rate. I mean, they lost their home in a fire. They had to get the house rebuilt. And now they got all this debt for whatever the other reasons were. And financially, look, I wrote this here. The home is doing the heavy lifting. And we've talked about this before, that people are going to get creative. Banks are getting creative. Agencies and government, local stuff is getting creative to help out and ease some burden in housing. And people are going to have to make some hard choices. And maybe in this case, it wasn't that hard. It might have been easy to go, I'll just take the refinance because I need this debt off my back.
Yeah. Well, here's the thing. We are sitting on this is the most equity anybody has ever had.
Ever.
So normally when you purchase a home, you just purchase a home because you don't want to deal with the increase in rent or getting kicked out of your home. You just want that dream of home ownership, so you do it. We never imagined we'd have a ton of equity the way we've been building it these last years,
Yeah.
And so when you're having that equity, we miss that. Thankfully, we have that there, so we're able to leverage it, And so, like Brian was saying, we have a client that has $9,000 and change worth of debt. I'm consolidating everything into one. His new payment is going to be like $5,600, which is going to save him like $3,400.
Wait. You're saying the $9,000 was monthly out-of-pocket expenses?
Yes.
Out of pocket.
Yes, that's what I'm saying.
Oh, wait. Okay, I'm sorry. I didn't know this.
Yeah, so we're actually taking $195,000 paying off debt. That's a total of $5,800 monthly.
Whoa.
Right? And with his mortgage of 33, because he's got a great rate, 2 and change. I'm not a big fan of it, but when I do the numbers, this is where the mortgage accelerator calculator came into place again, which we love. I taught him how to reinvest in that. It's going to take him 6 years to get back to where he's at today.
Wow.
By putting $1,200 on every month.
Oh, extra.
Principal. Yes.
Okay.
From that 33 that he's already saving, put $1,200.
Wow.
And then you're going to send a $2,000 extra payment annually.
Wow.
And that put him back. It was 7 years.
And wiping out $194,000 of debt?
That was going to bring him, because his balance is $588. We're going to do a new loan at $800.
Yeah,
so
okay.
In the 7 years, if he follows that formula, that's it. He'll be under that.
That's crazy.
And that's right now at a 6.25, because it's a larger loan.
Right.
So once we refinance later down the line, those numbers will change.
Dang.
So it's just leverage at its best. You just got to learn how to use these tools that you have that are available,
Yeah.
And I mean, consumers aren't, dropping their credit limits anytime soon.
Yeah.
I mean, we went from what, 1 billion to 9 billion. Remember I sent you that message? I was like, Andy, am I understanding this correctly? Like, is this information
consumer spending?
True? Because I'm like, they went from 1 billion to 9 billion. I'm like, That's
Yeah.
almost a
It's
10x
crazy.
increase, bro.
Yeah.
Like I'm like,
Yeah.
what?
I still have to look into that because it has to include something it didn't before.
Yeah,
There's no way it went
what-
900% higher
Like
just
what
in 1
just
month.
throws me off is that like
Because that's not reflected anywhere else in the economy. By the way.
I'm
It's
like,
just that
yo,
one
like,
figure.
hey, yo, is anybody else seeing this?
Well, we already
Yeah.
saw these says credit scores are at its biggest decline.
Yeah.
You know, credit scores.
Yeah.
And now we're at that $1.13 trillion in debt, credit
Yeah.
card debt. It's crazy.
Yeah, and growing.
And growing.
All right, guys, we got CNBC. Weekly mortgage demand surges 11% as more homes hit the spring market. I was asked a question yesterday, like, hey, how's things at your office? I was like, the guys keep opening escrows. So, look, I understand people are like, oh, the mortgage industry sucks and it's dead. And it's not really dead around here when you guys are opening new escrows.
Yeah.
And it's represented by this number nationwide. And we're seeing increases here as well.
Yeah.
So
People have stuff they need to refinance. They got problems they got to get out of, and they're looking at their future and going, "How can I use this house, this loan, and this access to money to get myself where I need
That's
to be?"
right.
So I have an example from a client right now that's refinancing, and they had a payment super low as well. I think they were paying like $2,700. They started doing renovations, construction on their house, and they paid off debt with a HELOC that we did last year. But then this time around, we were doing a cash out refinance to pay off their HELOC, and then additionally finish some repairs that they were doing around the house. So we ran into an obstacle where their property complex wasn't able to, have the things that they needed in the back end to have the loan go through FHA financing.
A reserve.
Yeah, reserve. They didn't have enough allocated reserves to be able to pass it through the FHA financing. So we either had two options: either wait till they do have their reserves, which their fiscal year ends in June, or we could try finding a different route that might be a little bit different, might have to adjust and make things different from what we already had it set up the other route. But what I got from that is that the rate was higher. The payment, yes, was a lot higher than what we initially had. I think it was like $300 more. But what I took from it is that the client, once I broke everything down, like, hey, I'm sorry, like this is what it's gonna be. This is how it got adjusted. She's like, I need the money. I need to finish the
just need
repairs.
it.
I need to pay for this. Like at this point, like I'm kind of locked in. I need the money. I'm able to pay for that for the monthly payment. They make $11,000 a month, so like they could cover the payment that went up to like $3,900 and change. So for them, it's more important to obtain those funds and get what they need to get done, regardless of what the payment is. My thing to them was like, hey, I know this is going to be uncomfortable for the first couple of months, but the good thing is that rates are on their way down. We've been following this. We know this for a fact. So it's just going to be a temporary Band-Aid. 6 to 8 months, 8 months tops, we're going to be able to then see what the market's doing. And if rates are a little bit lower at that point, guess what we're going to do? We're going to refinance you down from that rate and get you that savings that we did intend to give you. And you might save more than what you were additionally if we would have done it earlier in the year. Yeah. So what I got from that is that people are going to need what they need when they want it. And regardless of the situation, like if their life presents that, hey, I need this money or I need to make this move, who cares what the market is doing? Who cares what economy is doing? They're going to make the decision based off what's going to benefit them and their family so that they can get to where they want to be.
Correct. They're going to figure out, how am I going to get this done? Because it's already stressful enough.
Consumers
just to see
aren't
things
thinking
in
like,
shambles, right? And
I think that's a theme I overhear you guys talking to people and the situations and all that. And what I'm overwhelming here is people are looking for solutions. And they're looking for solutions. And when they're out of them in these other peripheral areas of their life, they're like, okay, I'm gonna turn to my house. I'm going to turn on my equity. I'm going to turn on my line of credit, whatever, because I have this, I'm log jammed or I'm roadblocked or I'm boxed in over here. I got to free myself up over here somehow and get myself back on the right course. I mean, it's hard. I understand it's a hard choice to make. It's not necessarily the one you want to make, but of your available options, it might be the best one, even of a nasty lot of choices.
That's it.
I feel like, unfortunately, just human nature, we wait until things got really bad to then go and try to do the thing that I should have done beforehand. Like if you already knew you were going to be drowning in debt, maybe tap into your equity a little bit sooner, but you wait until you're literally capped out to be like, all right, now I want to go in. But sometimes that's a catch-22 because all your stuff is so maxed that when you put your loan through, sometimes it might not work out. So I always say just make sure that you're always checking in with somebody that can give you a perspective outside of your emotional perspective when looking at your finances so that you're able to understand exactly what the numbers look like. Like when William breaks everything down and I look at it, I'm like, yo, that makes sense for your client. Like, have those conversations, and although they're going to be uncomfortable, speak to whoever you're comfortable with talking about your finances, whether it be us, whether it be another loan officer out there that you trust. Make sure you're having those tough conversations because down the line, if a situation like this arises, you want to be prepared, don't you?
Yeah, that's it.
This is why mortgage demand is surging. It's not just purchase loans. It's because people are in situations they need out of. It comes down to three things for me, guys. It's credit cards, consumer spending,
Yeah.
and equity. You have a problem, and a solution. So for those people who are homeowners and you have a lot high credit card balances, high credit card rates, you have consumer spending that's maybe out of control, and you need to curb that in your own personal spending behavior, the equity might be your way out. And again, people in the comments are like, oh, you guys sell loans, you're supposed to say that. Like, look, this might actually only be people's only choice. So, fine, I hear you, but also I'm not going to dismiss the fact that if someone's in desperation and need and their house can come to their aid, that's what we're here to do.
Yeah. And you know what? I'm okay with that. The good thing is what we're saying and what we're doing right now are things that are currently being applied.
Yeah.
And if most people don't hear about that, they'll never know what they're able and capable of doing.
Yeah.
So yes, we talk about these things to encourage people to plant a seed, to give them ideas like, what is that I can do if I'm in that situation, or just ask somewhere where you're at.
Yeah.
Let me see what I can do to get out of this stressful situation.
Yeah.
$195,000 worth of debt. Could that be pretty stressful?
That's a lot. Yeah.
When you have, and then how long, one of my questions was like, how long do you think it's going to take you to pay off that 195? You know what the answer was?
20 years?
No, he said forever.
Oh,
exactly. Right?
Okay.
Exactly. So the way we're teaching is, here it is. Here's your math. Here's the formula. Here's the calculator. Utilize it, and this is what we're doing.
Yeah.
Math doesn't lie. Here you go. It's not like we.
Yeah. I mean, how much longer are you going to be able to pay $9,000 out of pocket to service that debt before you finally got to make a choice?
Well, just to like add on to your point, it is our job. It is our job to go speak about this. It is my job to tell you these things.
Yeah.
Because when you go to the doctor, sometimes you don't like what they tell you, do you?
That's it.
But do you have to follow what they told you so that you get better?
Yeah.
Absolutely.
So I'm like, I'm not saying I'm a doctor, but I'm like, yo, I do this every day. I reference the mortgage doctor.
Yeah, mortgage doctor.
No, but what I'm saying is that we're doing this, seeing this day in and day out, If we're saying, hey, you should probably be doing this, I am saying it because it benefits you.
Yeah.
And of course, it is my job, so it's going to benefit me as well. But if we can both win and I can help you get to your solution and you can help me get to my solution, well, does it really matter at that point?
Yeah.
We're both winning. You get your solution and I got my job done.
Absolutely. And the other thing is, we're here in California, they passed that ADU law. We're leveraging the heck out of that.
Oh, heck yeah.
That's like our gold rush here in California, right? So if we can teach these people that have a ton of equity, which we've been doing quite a bit of ADUs now, financing those, I'll tell you, how many people do not get emotional when they call us when they get done with that and they have it rented and they're like, oh my God, this is like, it's just a game changer.
And one thing I feel that, that we get railed in the comments like, oh, you guys are mortgage people, you guys do that. But at the end of the day, like if I can't help someone, I'm going to tell them, yo, I can't, know? And it's my job in my career to do this and stay in business for as long as possible. So, influencing one person in the wrong direction isn't my goal because I want to be here 10, 15, 20 years down the line. So for me, I want to make sure that I tell you the truth, even if you don't like it. Go somewhere else. Have them lie to you.
Yeah,
come
exactly.
Back and I'll be like, hey, you told me the truth.
Well, just like you brought out the Dr. Brian. Example, and that we say, go get a second opinion or third opinion if needed, right?
Yeah.
If the situation is that severe, go get a couple opinions. Yeah. Simple as that.
You're free to do so.
No, demand's going to continue, guys. That's just going to be the way of it. I mean, situations are going to force people into those corners, and they're going to have to make choices. So it's either going to be you're going to refinance and get yourself out of debt, or you're going to list your home, which is going to create more inventory. So I think that's the summation of the show for today.
Yeah, there you go.
What was your favorite part of the show today, Memo?
My favorite part is after your graphs, I know that I'm going to be right at the end of the discussion.
Andy's going to be wrong. That's what you like most about the show? That. I'll be wrong in the future. Okay, got it. Brian, how about you?
Everything's up.
Everything's up.
My favorite part, guys, was actually the mortgage demand. Like, I know people are going to have to.
Are you sure, Andy?
You're going to have to use. It's not the graphs and the data today, guys. It's the demand is up. I mean, look, we know that demand's been really low for a long time. Demand is back. We're going to end up helping a lot of people this year get themselves out of situations they got themselves into spending wise, and that behavior will change. I'm optimistic that will change for some people, but they just need to start again. They need a fresh start, and I think that's what they're going to get when they refinance, do a line of credit, that kind of thing. So, thank you guys for being prepared. Thank you so much for joining once again for another awesome show. I appreciate you guys very much for being so willing to share what's happening on the front lines with everybody, because we don't have to be in front of the cameras talking to everybody about this, but I really enjoy you sharing all this so people can hear for themselves and then make some qualified decisions.
No, we also thank you, Andy. You know what? To our guests that are watching us and supporting us, like, thank you so much. Even if the comments don't sound right, just give it out to us. We're okay with that. Like, we're seriously, we want to hear from you. And we do this every week because we truly appreciate what you guys do for us. So we just want to give back.
Yeah. Well, thank you guys for another great show. Thank you all for watching. Remember to like this video and subscribe to our channel. Turn on notifications so that every time we launch a new video, you hear about it first. And if you're listening to us on Apple or Google, remember to turn on direct download so that you get every episode as soon as it airs. Thank you guys so much for watching, and we'll see you again next week.
That's it. Thank you so much.